Now, with all the talk about rising interest rates, banks are right now in the spotlight. I told you yesterday that Westpac will update its profit outlook tomorrow as it delivers quarterly results. I also told you it's likely to be a very tough day as Westpac has had interest margins trimmed and squeezed enormously as it's chased market share in mortgages by cutting rates in the back end of last year. One man who's been watching the banks closely, Nathan Zaia, banking analyst with Morningstar. And Nathan, many thanks for your time. One of the things about the Reserve Bank statements now, does that change any of the outlook, do you think, this talk of rising interest rates sooner rather than later? Does it change the outlook for the banks?
I think not really. Like imminently, it helps their bottom line profits. It gives them the ability to reprice their back book. But we've been thinking longer term rates are going to have to go up. So we've already factored that into our outlook on the banks. It's more noise and what will drive the share price in the short term, I think, whether it happens sooner or later.
So the mortgages are such a big part of our major four commercial banks. And so the problem is when rates drop to, close to zero and you've got a mortgage with a one in front of it, everybody reprices. Everybody tries to get that cheap rate. And that's the fundamental problem for banks now. They've got to get margin to be able to actually get something out of that mortgage book.
Yeah, and we do expect them to be able to reprice that over time. The other part of this is their customer deposits. For Westpac, it's gone from 65-70% of their loans to over 80%. So that's a lot of cheap funding. So as it reprices its loans later on, that funding cost won't rise by the same extent. So that's why we do expect margins to improve over time, but there are a few things along the way that are probably going to cause them some pain.
Okay, so let's go to that pain, because that's my understanding of where Westpac sits right now and what they'll announce tomorrow. Plus, also, I understand the ANZ's in the same situation. They've been slow at being able to process loans. But in terms of Westpac, it seems as though they've tried to chase market share. To do that, you've got to offer lower interest rates. If you offer lower interest rates, your margins get squeezed, your profits get squeezed, and that's a fundamental problem.
Yeah, that's exactly right. And Westpac found itself in that position because its loan approval times blew out. We can rewind a little bit. We had the Royal Commission, we had AUSTRAC. There's a lot of caution, and they just didn't cope. But then at the same time, we had COVID unexpectedly brought this massive influx of refinance applications, and their approval times just blew out. So if you're a broker, you're not going to turn to the bank that's taking way too long to approve a loan. House prices skyrocketing. You need an answer yesterday, basically. So, Westpac found themselves in a position, do we just keep losing market share, or do we try and get back in there with some really sharp pricing? And that's what they've done. Their loan volumes did pick up, but even in the last quarter of the year, we started to see that decline a bit. So it'll be interesting to see whether they've taken the pedal off a bit, or in fact their loan application approval times just blew out again because they did get all this demand. So it'll be interesting to see what they say around that.
So a couple of things I want to identify for people. One is the chart that you've put together of the financial sector as compared with the broader market. And what this shows, if we have a quick look at it here, is the red line, the financial sector, which includes insurance companies and the banks, has significantly underperformed the overall market. Now, okay, there are tech shares in that overall market, but it really does show that these banks, as a result of the squeezed margins, are the major part of that underperformance there.
Yeah, and there's also the asset managers which have followed the market, and people are worried about their pricing and margins there too. But I think the market seems to be more worried about what's going to happen to their profitability short term, rather than all this talk we've got about interest rates going up, which is actually a good thing for the banks longer term.
And the second chart I want to show people here is just the net interest margin. Now, the net interest margin is also fascinating. Now, we should point out that where it's declining to here on this particular line, you're basically saying it will eventually rise with rising interest rates. But until that happens, of course, the banks are being squeezed.
Yeah, that's exactly right. And I mean, there could be further downside to that. As these banks do chase market share and try to hold on to their positions. But we think it's important that they do that, because as rates do rise, you get to reprice that back book, and having the customer there in the first place is part of the challenge.
So in other words, when you see things like tomorrow and the Westpac coming out, net interest margin is one of the key indicators that investors should be watching.
Yeah, I think in the short term, it's really going to impact their profits, but I think if you think longer term, will Westpac be in a position to compete with its peers on service and price? If you think the answer to that is yes, which we do, then I think longer term, its profits and its returns should improve.
Nathan Zaia from Morningstar, many thanks for your time on the program today.